Imagine a single decision that can shake global markets, shift billions in revenue, and redraw the balance of power overnight. Imagine a world where every barrel of oil isn't just fuel, it's influence, leverage, and control. Tonight, we dive into a story that governments, corporations, and investors are watching closely. A story where strategy meets power, and every move has consequences. This is not speculation, this is real. This is unfolding as we speak. And what's happening now with Venezuela's oil industry could change the rules of the global energy game forever. Buckle up, because what you're about to see will challenge everything you think you know about energy, politics, and money. When Washington decides to tighten its grip on an industry, it is never impulsive, never emotional, and certainly never accidental. This moment with Venezuela's oil sector is not about punishment alone. It is about control, predictability, and leverage in a world where energy remains the ultimate strategic currency. Oil is not just fuel, it is influence. And influence, when unmanaged, becomes risk. For years, Venezuela's oil production drifted into inefficiency, opacity, and geopolitical ambiguity. That ambiguity created space for informal networks, sanctioned intermediaries, and shadow transactions that distorted markets and weakened accountability. Markets dislike shadows. Capital avoids uncertainty. Washington understands this better than most. By asserting tighter oversight on how Venezuelan oil is produced, sold, and monetized, the United States is effectively reshaping the rules of engagement. This isn't about shutting supply off. It's about deciding how supply re-enters the global system and under whose supervision. That distinction matters. Oil that flows without transparency destabilizes prices. Oil that flows without oversight undermines sanctions regimes. And oil revenues that move without structure prolong dysfunction rather than resolve it. What we're seeing now is a recalibration, one designed to reintroduce Venezuelan crude into global markets without surrendering leverage. Revenues are monitored, transactions are structured. The objective is simple: prevent misuse while maintaining stability. That balance is not easy, but it is intentional. This approach also sends a broader signal to energy markets worldwide. The message is clear: access to the world's most liquid energy markets comes with conditions. Those conditions reward compliance, transparency, and long-term discipline. This is not ideological, it is structural. Markets operate best when rules are enforced consistently, not selectively. Critics will argue that this represents overreach. But the reality is that energy policy has always been inseparable from national security. Every barrel has a destination, every dollar has a consequence. Allowing unchecked oil revenues in fragile political systems does not create reform, it delays it. For investors, refiners, and global stakeholders, this move reduces uncertainty. It clarifies pathways. It replaces chaos with process. And in capital markets, process is confidence. Venezuela sits on vast reserves, but reserves alone do not generate prosperity. Governance does. Oversight does. Discipline does. Tightening control over oil sales is not an endgame, it's a mechanism. A mechanism to stabilize output, influence behavior, and ensure that energy flows serve broader economic order rather than narrow interests. In the end, this isn't about who owns the oil. It's about who shapes the system through which that oil moves. And in today's world, the power to shape systems is far more valuable than the power to extract resources. That is the reality Washington is responding to, and the reality global markets are quietly adjusting to. Large-scale oil transfers are never just transactions, they are statements. When tens of millions of barrels are redirected under new supervision, markets don't see cargo, they see intent. Volume matters, but control over volume matters more. This latest movement of Venezuelan crude is less about relieving shortages and more about reasserting order in a market that has spent years reacting instead of planning. Energy markets are sensitive organisms. They respond instantly to uncertainty and slowly to clarity. What Washington is doing here is injecting structure into a system that had become fragmented. By guiding where Venezuelan oil goes, how it's priced, and under what conditions it moves, policymakers are dampening volatility before it shows up on a trading screen. 30 to 50 million barrels is not insignificant, That amount influences refinery margins, shipping rates, and benchmark spreads. But the real impact lies in how that oil is introduced. Supervised flows prevent sudden gluts. They discourage opportunistic intermediaries. They reduce the chance that oil becomes a tool for destabilization rather than supply. From a market perspective, this is risk management at scale. Unregulated oil flows tend to distort price signals. They create artificial discounts, encourage arbitrage through opaque channels, and weaken the integrity of futures markets. Bringing those barrels into a monitored framework restores signal clarity. And clarity is what markets price most efficiently. This also reshapes negotiating power. When oil moves through controlled pipelines, financial and logistical leverage shifts. Buyers gain predictability. Sellers lose discretion. That asymmetry is intentional. It aligns behavior without requiring constant intervention. The system enforces discipline on its own. Refiners in particular benefit from this structure. They can plan feedstock mixes with greater confidence. They can hedge exposure more accurately, and they can invest knowing that supply will not disappear overnight due to political shock or enforcement surprise. Stability lowers the cost of capital. Lower capita costs invite reinvestment. Of course, no strategy is without trade-offs. Controlled flows limit upside for producers in the short term. They restrict flexibility. But flexibility without governance has already proven its cost. What replaces it is not coercion. It's conditional access. Access to markets, access to dollars, access to scale. This approach also has global implications. Other sanctioned or semi-sanctioned producers are watching closely. The lesson is subtle but firm. Reintegration into global markets is possible, but only through compliance, transparency, and alignment with broader market rules. This is how norms are enforced without confrontation. Ultimately, the redirection of Venezuelan oil at this scale reflects a shift from reaction to architecture. Instead of chasing disruptions, policymakers are shaping pathways. Instead of blocking supply, they are channeling it. And in doing so, they are reminding the world that in energy markets, control over flow is often more decisive than ownership of reserves. That's the real signal embedded in these barrels, and markets, as always, are listening. Sanctions are often misunderstood as symbolic gestures. In reality, they are instruments of enforcement designed not to announce intent, but to alter behavior. What we are seeing now in Venezuela's oil sector is not the expansion of sanctions for optics, it is the refinement of enforcement for results. There is a meaningful difference. For years, sanctions exist. On paper, while workarounds flourished in practice. Oil moved through shell companies, reflagged vessels, opaque trading desks, and financial gray zones. That ecosystem didn't collapse overnight, it adapted, and markets learned to price around it. That is precisely the problem enforcement is now addressing. Tightening the grip means closing loopholes that had become normalized. It means tracking tankers, monitoring ship-to-ship transfers, scrutinizing insurance arrangements, and applying pressure where it actually hurts, logistics and finance. Oil doesn't move because it exists underground. It moves because a network enables it. Disrupt the network and you regain leverage without firing a shot. Recent actions signal that tolerance for circumvention has ended. Companies once operating in the shadows are being named. Vessels are being flagged. Transactions are being frozen or unwound. This is not broad punishment, it is targeted precision. Enforcement has shifted from volume-based to behavior-based. Markets respond quickly to that kind of clarity. When participants know rules will be enforced consistently, risk premiums adjust. Speculative arbitrage dries up. Illicit discounts narrow. The cost of non-compliance rises above the cost of cooperation. That is how sanctions achieve impact without escalation. There is also a deterrence effect beyond Venezuela. Shipping firms, insurers, traders, and financiers across the globe are recalibrating exposure. The message is unmistakable. Facilitating sanctioned oil flows is no longer a manageable risk. It is a measurable liability. Once that realization sets in, compliance accelerates organically. Critics argue this approach weaponizes finance, but finance has always been a gatekeeper. Capital decides what gets built, what gets shipped, and what gets insured. Using that reality to enforce international norms is not distortion, it is alignment. Enforcement works best when it mirrors how markets actually function from a strategic standpoint. This tightening reduces unpredictability. Rogue supply chains inject volatility into pricing models and geopolitical calculations alike. Eliminating those chains does not remove oil from the world. It forces oil back into regulated channels, and regulated channels are easier to forecast, hedge, and manage. This is not about isolating Venezuela indefinitely. It is about defining conditions for participation. Enforcement is the bridge between pressure and reintegration. It signals seriousness without closing the door. The choice remains available: operate within the system or outside of it, but the consequences are no longer ambiguous. Ultimately, sanctions succeed not when headlines announce them, but when markets internalize them, when behavior changes quietly, when risk models are rewritten, and when compliance becomes the default rather than the exception. That is what effective enforcement looks like. And that is the phase we are now firmly in: geopolitical. Tensions are rarely abstract. When a major economy asserts control over another country's critical resource, the ripple effects are immediate, tangible, and measurable. The recent tightening of oversight on Venezuelan oil is not simply a domestic policy maneuver. It is a calculated shift in the balance of influence across the Western Hemisphere and beyond. Every decision in this space carries consequences that extend far beyond the borders of the countries directly involved. For decades, Venezuela's oil industry operated as both an economic engine and a political lever. International actors, from state-backed energy firms to multinational trading houses, have long tried to navigate a landscape defined by sanctions, underinvestment, and political unpredictability. Each barrel of crude leaving the country has been a point of negotiation, a bargaining chip in a much larger geopolitical calculus. By introducing stricter oversight, Washington is reshaping the parameters of that calculus, determining who benefits, who bears risk, and who must adjust strategy. The international response has been instructive. Countries that see themselves as competitors in energy markets or that have long-standing alliances with Venezuela have reacted with criticism, diplomatic warnings, or strategic recalibrations. That pushback is not just political theater. It signals the stakes involved. Energy, in the modern era, is inseparable from influence. Supply chains are lifelines and control. Ing them effectively becomes an instrument of leverage. When one actor centralizes that control, the world notices. From a market perspective, this recalibration introduces both clarity and friction. Clarity comes from the fact that flows, revenues, and compliance are now under tighter supervision. Investors and refiners can model exposure with greater confidence. Risk premiums can be adjusted with accuracy rather than conjecture. Friction, however, arises from the international pushback, potential legal disputes, and the recalibration of long-standing trading relationships. Both elements are critical. Markets thrive on predictability, but they also price uncertainty. This maneuver redefines both. It is also worth noting that these measures are as much about signaling as they are about immediate economic effect. The demonstration of enforcement capability, the ability to oversee transactions, and the willingness to apply pressure on intermediaries are all signals. They communicate seriousness not just to Venezuela, but to the broader energy and financial communities. Compliance is no longer optional if long-term participation is desired. Finally, the economic and energy implications domestically cannot be understated. U.S. refiners, for example, stand to benefit from predictable access to high volumes of crude, while the broader global energy system adjusts to the new alignment. Countries reliant on Venezuelan exports must now recalibrate sourcing, pricing, and hedging strategies. In effect, tighter control over Venezuelan oil has become a lever, a mechanism for reshaping energy flows, realigning influence, and creating a predictable framework in an otherwise volatile region. This is not a transient shift. It is a structural adjustment. It is an exercise in long-term positioning where economic outcomes, geopolitical strategy, and market stability intersect. The reverberations will be felt across continents, in trading floors, diplomatic corridors, and boardrooms alike. In the world of energy, influence is the most valuable currency, and control over supply is how that influence is exercised. Economic and domestic energy implications are rarely accidental. When control is asserted over a critical export sector like Venezuelan oil, the effects are felt not only abroad but across domestic markets, corporate strategies, and investment decisions. This is not a simple matter of shifting barrels from one pipeline to another. It is a deliberate intervention in a system that touches refining, shipping, finance, and energy security simultaneously. For us refiners, this oversight introduces both opportunity and constraint. Predictable access to crude allows for optimized refinery planning, better hedging against market volatility, and improved margins. At the same time, stricter enforcement protocols impose compliance costs, monitoring requirements, and operational discipline that were previously optional. These constraints are not arbitrary. The EY create a structure in which long-term efficiency and reliability are rewarded and short-term opportunism is penalized. Markets respond accordingly. Predictable flows reduce the risk premium, incentivizing capital deployment in infrastructure and operations that might have been deferred. Beyond the immediate players, this shift sends a clear signal to global investors and energy stakeholders. When crude exports move under a framework of oversight, it signals that the rules of engagement have changed. Investment decisions can no longer be based solely on available reserves or historical output. They must now factor in governance, compliance, and alignment with broader market and geopolitical strategies. In essence, control over flows becomes as valuable as control over reserves. This reconfiguration also influences international negotiations. Countries that previously relied on unregulated access to Venezuelan crude must now recalibrate supply chains and hedging strategies. New alliances, contracts, and partnerships will emerge, while those unwilling or unable to adapt will face increased cost and reduced market share. In energy markets, timing, access, and reliability are often more decisive than absolute volume. Structuring access around predictable compliance creates a competitive advantage that is difficult to replicate. At the macroeconomic level, channeling Venezuelan oil through monitored pathways has implications for price stability and fiscal policy. By reducing the volatility associated with illicit or opaque flows, markets can respond more rationally to supply and demand fundamentals. Domestic economic actors, from refiners to shipping companies to financial institutions, benefit from a more calculable environment. For policymakers, it allows for the integration of energy security objectives with broader economic strategy. Finally, this is a lesson in leverage and systemic thinking. Oil is not just a commodity, it is a tool for shaping behavior, aligning incentives, and projecting influence. The value of a barrel is not in extraction alone, but in how it moves through systems, how it is monetized, and how it reinforces order. Tighter control over Venezuela's oil industry exemplifies that principle. It is an exercise in disciplined market stewardship, long-term positioning, and strategic foresight. Those who understand the dynamics and who act decisively will benefit from clarity and opportunity. Those who fail to anticipate will absorb risk and uncertainty. In the end, the interplay between domestic energy policy, global market stability, and economic incentives demonstrates one immutable truth: in complex systems, control over flows, compliance, and structure is as critical as ownership of resources. And in that truth lies the opportunity for sustainable advantage, calculated profit, and strategic certainty. As the barrels move, as the deals are sealed, and as oversight tightens, one truth becomes undeniable. In the world of energy, nothing is ever just about supply and demand. Every decision, every transaction, every shift in control sends ripples across markets, governments, and lives. The game is bigger than politics, bigger than economics. It's about power, strategy, and who really controls the levers of the world. And make no mistake, this story is far from over. Every move from here on out will be watched, calculated, and felt across continents. The question isn't whether the world will change. It already is. The question is, will you be ready to understand it, anticipate it, and act before it moves again? Because in this high-stakes game, only those who see clearly will survive and thrive.